All right, guys, here we go. First of all, we always go through a couple of things. First is our disclaimer. I'm not going to give you any trading advice specific to any particular trade. Therefore, you can't hold us responsible for telling you how to trade. You do make your own decisions. You need to make your own decisions. Here's our calendar of things coming up. This is what you're used to seeing. There is, however, this one, which is a special class coming up that Rob is doing on gaps, which is awesome. Gaps is an incredibly important principle in trading. It's a reflection of personalities. Okay, you really have to put a little bit of English, put some spin on this, and understanding gaps is crucial to your trading. All right, now I want to start out with a review. I always like to do this because as I teach these classes, these coaching classes, I try to move from one subject into the next and have them be relative. And especially just with the principle of wanting to know if you remembered anything from the last time we got together. This is one of the slides that we worked at that was a bit of a summary. And this says that how to properly use indicators. That's what we talked about last time. Do you remember I told you there are no leading indicators? There are things that are called leading indicators. It's a sleight of hand, bad choice of words. There is nothing that leads anything except inside information. Okay, price is determined when traders face off with each other based on the things that they know. If you happen to know something that nobody else knows, well, then you could have inside information, and perhaps then it would have a leading indication of what's going to happen, perhaps. But most of the time it's contrails, which is that smoke coming out of the back of the airplane. It's really not smoke, steam, if you will, as it flies through the air. Or sparklers, when you kind of wave them around at night, it seems to leave kind of a trail in the sky. That's what indicators are. They trail. They always trail. But they look at things from very, very different perspectives. How much weight do you put on indicators? Well, only as much as they deserve. How do you decide that? By looking at their recent performance. Most recent performance, meaning about 6 to 12 months. All right. How many indicators should you follow? Well, there's no magic to that. The principle is to don't overload. And we're going to be talking a little bit more about that today. And which indicators are the best? Well, there's about 100 of them. So which ones are the best? The ones that you can figure out how to make work for you. I'm not saying that there is magic ones. There's ones that I like to use because they seem to work for me. Other people that are good traders have other indicators that they follow. And hey, if it works for them, it works for them. It's a tool. That's it. It is not a magic crystal ball. It's a tool. And if you can make that tool work for you, more power to you. All right, indicators, just a further review, come in 4 types and 2 types. There's trend following, oscillators, volatility, and support and resistance. We went through all of those. Oscillators are, as you look down at the bottom, it says MACD, RSI, stochastics. Those are example of oscillators. What you don't ever see unless somebody deliberately does it, which actually I've done, and I think it's kind of cool sometimes, but generally, you don't see oscillators on the same screen as your price. Overlays, which is right above it, moving averages, Bollinger Band, things like that, they're drawn right on the price screen. So an overlay is something that's drawn on the price screen. Oscillators typically are in their separate windows. And that's because they really don't relate to, at least they're not designed to relate directly to price as an overlay. It's looked at as a separate. Now, sometimes it's interesting to overlay it, which you can do in a lot of charting programs. You can with our charting program, but typically they're not. But trend following, oscillators, as we mentioned below, volatility indicators, and support and resistance indicators. There's a lot of different versions of the support and resistance. Anyway, those are the different types. So with that, excuse me, we're going to segue. And we're going to segue right into what we want to talk about today. The name of the class is analysis as it relates to, or as it is part of trade management. Analysis. Well, using technical indicators, that's part of analysis. Okay, it is. But analysis is broader than that. And some things that you'll recognize are going to be augmented by something that I wanted to share with you to add to your perspective on analysis. Okay. So I broke it down into 3 parts. Typically, it's usually 2. Risk management and trading neutral are the 2 biggest. Those are the broad brush umbrellas that cover trade management in my book. Trade management is composed of risk management and being able to trade neutral. Why is trading neutral so important? Trading neutral is where you recognize that you have no control of the price. You have no special knowledge that nobody else has of what's going on. And therefore, you've got to trade neutral. You can't say, well, I just know the stock is going to, or I think the stock is going to go. Guys, the word think is a 1, 2, 3, 4, 5-letter word. It's deadly, because when you say, I think, you are putting your opinion into the trade. You put your opinion into the trade, you've just committed a 50-50 chance at something that's lethal. Can you imagine? You've seen Russian roulette, which is portrayed by a revolver pistol that you put 6 bullets in, only you empty them all out and you put 1 bullet in the chamber, spin it, and now you have a 1 in 6 chance of killing yourself. Guys, nobody feels comfortable doing that. What if you put 3 bullets in, 3 out of the 6, spin the cylinder and say, give it a shot? Yeah, I don't think so. And when you say, I think, you are turning to a 50-50 proposition because you have no idea. Now it's a crapshoot. You just flip a coin in the air and hope you get heads or tails. And if it's lethal to you financially, that's stupid. Okay. That's why trading neutral is a whole subject all by itself. I love teaching about it, but it's a critical part of trade management. Risk management, that's another element of it. Okay. But I want to introduce Perpetual Beta. And we're going to add that to the mix today. So, trade management, determining the potential reward. That's where you look at charts. You try to figure, it's part of your risk management. What is the potential reward? How far could this stock move? If it follows the pattern and goes to support or goes to resistance, how far is that? How much money could I make on it? And that's part of your risk management. You've got to determine what the reward is. You look at supporting data. Okay, is there anything that firms up the picture I'm seeing on the charts? Well, you look at indicators, you look at candles, you look at news. That's supporting data. Those are other indicators that you can look at that will add weight to what it looks like it's going to do. By the way, I said think is a 5-letter word. I made that point because I want you to replace it. If I was doing the full class on trading neutral, would replace that with another 5-letter word that will change your life. All right. Stay tuned. Now, you determine entry and exit points. This is part of the trading neutral. If this happens, then I get in here. If that happens, then I get out there. If then, you put in conditional moves and you evaluate that. You look at the size of the risk versus the reward. If I get in here and then get out there, what's it going to cost me? Oh, okay. How much is the reward? Oh, okay. Is it worth it? Is it worth it? If you're trading options, you got to look at the cost of the options, time deterioration, the in, at, or out of the money position. You look at delta, you look at gamma, you look at all things if you're going to play options, all kinds of things to determine your risk reward ratio. And if that all fits, you go ahead and you pull the trigger. Then you do a post-mortem. Did it work? What didn't work? And then you make adjustments as needed. That is essentially, those are the rough elements of trade management. But I want to introduce another component. Like in Deer Hunter. Yeah. All right. Now we're going to look at the next one. The new kid on the block, Perpetual Beta. I ran into this study. It's a book that was called Super Forecasting, the art and science of prediction. Dan Gardner, Philip Tetlock. Guys, this was fascinating. Here's some of the takeaways from the book. Life requires making prediction or forecasting. It does because of uncertainty, and we're alive, we're looking straight ahead. We have to be able to do some kind of forecasting to lend some sort of confidence in what we do next. Professionals outperformed by outsiders. When they did, this was fascinating, and they used investing and basically stock market investing and professionals as one of the groups that they studied. But across the board, the professionals in a field who did professional forecasting were outperformed by outsiders every time. They would take some people from the outside who were not professionals, and they would let them take a shot at it. And son of a gun, in every example they looked at, including trading, Wall Street guys, there was always a group of outsiders that outperformed them. Always. They recognize that the strongest predictor of rising into the ranks of super forecasters is called perpetual beta. And the definition that they give for perpetual beta is the degree to which one is committed to belief updating and self-improvement. Now, what does that mean? Well, again, you can read the whole book, but I'll give you the crib notes here. Belief updating. That means you're willing to say, oh, well, I thought that, okay, well, I guess it works different now. And self-improvement. That commitment to trying to improve, being open to new information is what, quite frankly, is the biggest stumbling block for the quote unquote professionals. They get short-sighted. They get tunnel vision. They're professionals after all. They have a reputation to defend, so they defend their reputation. They defend their methodologies. They defend their hypotheses, rather than saying, maybe that didn't work. Let's try something else. And often people from the outsiders are not so steeped in their own mysticism, their own self-aggrandizement, that they're willing to go, oh, that didn't work, try this. Now, you want to have some fun, especially, gosh, I used to teach this years ago. Now I almost am scared to even say it because of our crazy woke society. But I'm going to say it. There are differences between men and women. There, I said it. Now, shoot me if you want. I don't care. I know it to be a fact. Now, one of the differences generically, now this is not 100%, but it's a generalization that is very, very true. Women often, very, very often, make better traders than men. Even though the trading world is dominated by men, women generally will outperform men in trading. Why? Because there is a tendency, not an automatic, not an absolute, but a tendency for women to be a lot more objective. If something doesn't work, we'll try something else. And there's funny anecdotal information in male-female relationships where the male is absolutely holding on, digging in, gripping white knuckle to their opinion, to their belief of how it's got to be. And when it's not working, my wife in particular is really good at saying, well, why don't you try something else? And my answer is typically, no, this is going to work. I know, I've invested in this. I've studied it, or I'm sure. And she's going, yeah, but it's not working. Try something else. That objectivity, that willingness to change your belief or belief update, or to just focus on self-improvement rather than self-aggrandizement or protecting your opinion or your reputation, that's what gets in people's way. So super forecasters often are not the professionals, but the characteristic that they recognize is the ability to be committed to belief updating and self-improvement. Anybody have any questions on it? Do you grasp that? Is that interesting to you? Does it ring any truth? I'm just curious because nobody's made any comments. And, I've introduced something new, so I believe it's new. So I'm just wondering how it's playing. If I was watching, if I was looking in your eyes, I could tell. But without that, I'm getting some yeses. So excellent. So let's apply this now. When we trade, you have to predict, because you are predicting something that is worth trading, predicting something that is worth taking a risk. And there is risk in trading. So we do analysis. So the question today is analysis. How does it fit into a trading? How does it fit in with trade management, which we defined here as putting all of these things together, using indicators, determining by looking at option prices and charts and indicators and news and candlesticks and everything, and making a decision. How does this perpetual beta become a third part, a third leg that makes a wobbly stool now more stable? Analysis. How much is too much or too little? That's a great question. There's three components that I identified. Number one, mass data mining, the one-trick pony or winging it. And then finally, the Goldilocks principle. Okay, mass data. How many of you can relate to feeling overwhelmed at times by too much stimulus, too much information, too much stuff to comb through, too many indicators, Too many voices that are saying one thing and the other one saying the other one. Yes, no, maybe, I don't know. Yes, for sure. Nope, wait. Okay, getting lots of feedback on that. Okay, how many can relate to this? It's too complicated. I'm just going to use stochastics. I'm just going to use moving indicator. I'm just going to use Fibonacci. I'm just going to use it's almost for some people, a desperation move to just finally get rid of some madness and make it simple. Okay, I get that. And there's other people that are absolutely convinced this is the only thing I need to use. And you know what? If they make money consistently, I'm not going to argue with them. I'm going to say, really, show me how you do that. Okay, but I love this little example of all the blind people that are describing an elephant based on the one thing that they can touch. Okay, somewhere in between, there is a balance between overwhelmed and I'm just going to focus on one. Of course, there is the option of just whatever, winging it. Okay, and I love the example years ago in some market study where they used a chimpanzee that was just throwing darts on the wall and outperforming the S&P 500, outperforming professional money managers. I thought that was hilarious, just throwing the dart, right? That's the whatever. I don't care. I'm not going to even mess with it. I'm just going to wing it and see how I do. I don't recommend this. I don't recommend this. And I don't recommend this either. So how do you find this? How do you find the Goldilocks? That's just right. Folks, it is going to be you, not me. However, let me put this in perspective. I would strongly suggest that you listen to me and Rob and everybody and anybody else that you want to listen to and see what you can glean out of it that works for you. Ultimately, out of all of the choices, you are going to wind up becoming a successful trader who has a certain bag of tricks or bag of tools, if you will. That's a better word than tricks. A bag of tools that you use. It's just the results. Okay, that's what we're looking for. And if you can handle 14 indicators, more power to you. If you can make it work with one or two, that works fine. Guys, all that counts is the results. And do not think you have to copy anybody, but you can certainly learn by seeing why they do what they do. And some of those things will make sense to you. And some of them you go, I don't know, it just doesn't, I don't need that. That doesn't work for me. Maybe that works for them. It just doesn't work for me. And that's perfect. Sadly, I can't give you the secret recipe. But I think the key, and I really love this principle, and I will be utilizing this and teaching this from now on, and that is having a commitment to be able or open to belief updating and self-improvement, focusing on how can I improve? What is going to help make this better? Does this make it better? Nope. Okay, jettison it. Yeah, but I really like it. I don't care. If it isn't working, it's not working. Oh, by the way, just so you know, indicators can start working and then stop working. You can have an indicator that really seems to be working well, and then suddenly it doesn't work anymore. Quit using it. Mommy, it hurts when I do this. Well, quit doing it, right? Y'all know that. Y'all know that. It's hilarious. But it always hurts when I do. Well, then stop doing it. And if it starts to work again, great. You know, if it's a favorite, if it's done well for you, you know, pat it on the head and say, fine, you need a timeout. Let me know when you're ready to play nice again, and we'll play with you. You know, it's not a one-off. You know, we'll let you back in the game, but right now, you know, we need you to sit out. That's simple. Back to analysis. All right, here is a principle that I've taught you in using technicals, indicators, but it's a universal principle. And that is, whenever you look at any kind of a tool, from a chart to candlesticks to moving averages to whatever you're going to use, even news, by the way, the past is relative or prologue. You've heard this statement, past is prologue. Well, past is relative also. What has worked in the past is the strongest indicator for what will work in the future. Write that down, memorize that. What has worked in the past is the strongest indicator for what will work in the future. Now, how much past do we look at? History, it's important, but you got to drill down to context. I'm studying this stock. I really like this stock, and I've been seeing what it did in 1975 through 1985. Why? Oh, I just thought that was an interesting period in the market. Yeah, but it's not relevant. What it's done in the last 6 to 12 months generally is the most relevant. So recent past is most relevant generally. Why do I put that qualifier in there? Because what if you are trading a period that looks exactly like it did from 75 to 85 and it's starting to act the same way? Well, okay, maybe there's a longer term time frame that is relevant here. Maybe it's worth looking at. But generally, what happened in the last 6 to 12 months is far more relevant than what happened 2 years ago or 3 years ago. Okay. Now, that said, again, I'm giving you perspective and depth here. If you can look back and the stock behaves with the same kind of pattern over the last 5 years, and it's continued to do it over the last 6 to 12 months, that adds more weight to the pattern that you're looking at. That adds more weight to the indicator you're looking at. That adds more weight to everything because consistency builds confidence in a process, however, that is never more than a 50-50 game. Yeah, but Ryan, I've got all these indicators and I've got the last year and the 3 years before that. It's done the same thing every time. Great. That's good. Those are confirming. That adds confidence. Now, what are your odds? 50-50. What? Wait a minute. I just told you I've got all of this data and it all lines up. Has it ever done anything different than that? Well, yeah, but just a couple times over the last 5 years. Okay, so what are the odds that the next one, when you pull the trigger, what are the odds that this won't be or could be one of those times where it doesn't work? And guys, it's 50-50. You don't know. However, you can, when you do your risk analysis, you look at your cost and your reward, your risk reward ratio, and you say, I'm okay with that. I'm okay with that risk reward ratio. If you're okay with it, then all of those extra things just add all that much more confidence that if this goes, it's going to go well. And I know what it's going to do if it goes in my favor. But if it doesn't, this is where I exit. And I know that that could happen. So I'm not going to cry. I'm not going to throw a hissy fit. My children teach my grandchildren, you get what you get, so don't throw a fit. That's one of the families. My son and his wife have taught their 5 kids that, and you hear it all the time. When I'm around them, somebody starts complaining, the other ones will turn to him and say, hey, knock it off. You get what you get, so don't throw a fit. Okay, but that's the trading neutral component of it. Okay, so again, time frame, longer term time frames, longer term patterns are easier to predict than shorter term. If it's happened for the last 6 years, it is easier to make a prediction than just checking what it's done in the last 4 days. Okay, so there's a relativity to time frame. Okay, so history is history, time frames are time frames, relevance is relevant, and it all has to do with just kind of common sense approach to it, guys. Let me give you one example of all the indicators. I'll drill down on one of them. Candlesticks. I love candlesticks. It's one of the things that I've spent a lot of time getting to understand. What I hated in my formative years in studying candlesticks is when somebody say, oh, that's a good one. I would read it in books. I would see it on the internet. I would listen to people talk about candlesticks. Oh, that's a good one. And I just loved going right in their face whenever I could talk to them. And I'd say, define good. What is good? Okay. If you can show me something that consistently works on that stock, I'll let you say that. But when it came to candlesticks, everything was about relativity because there was data that you could actually pull. Good didn't mean anything. I would say, what's the percentage? Is it 80%, 85%, or 55%? How often is this right? Well, I don't know, but it's a good one. Why? Well, because I read about it and I saw a video and they said it's really good. And I don't know much about candlesticks, so I'm trusting them. Guys, that is horrible. Generalizations can be incredibly misleading. When you see a doji, this is what happens. Baloney. Baloney. What does a doji mean? Somebody, I'll just drill in on this for just a little bit. Somebody tell me, what does a doji mean? You know, candlestick doji, it's a little cross. It's like a little X turns straight up and down. What does it mean? Tripp says indecision. That's exactly right. That's all it means. Okay, that means the stock doesn't know what it's going to do. So what does a doji mean? Is it going to go up or down? The stock has been going down and it throws a doji at support. What's it going to do? And the answer is, I don't know. Neither do they. It's very obvious that you have a balance between buying and selling pressure. It's dead on even. Neither one has the upper hand. So which way is it going to go? How in the world could you answer that question? And yet I've seen people give examples and leave lessons on how to trade a doji. Okay, so you go down to support and it throws a hammer pattern. Okay, it throws a hammer pattern. What's that? It's a small body with a tail sticking down below it that's 2 to 3 times the size of the body. Oh, that's a bullish trading signal. So what's the stock going to do? It's going to go up. Really? What are the odds? Well, generically, I would say 50-50, right? I mean, that's my default answer. But with candlesticks, you can pull data, a lot of data. We've got computer programs, algorithms that can sort this out. And you can say, what are the odds that when you come down to a support level, you throw a hammer pattern and it reverses to the upside? There's a number for that. Well, what happens if you're just dropping down and you throw a hammer pattern? There's a number for that too. See, in this case, you weren't at support, you were just dropping down. Now, once you get those numbers, you might look at that and say, well, across the board, you know, the algorithm, when I look at all the stocks, that's about a 65% accurate signal. That's a pretty good signal. Really? How good? Well, 65%. Is that good enough? I don't know. I think yeah, I mean, it's pretty good. Well, how good is it on your stock? Well, I guess about 65%. Really? Are you sure? Because when you come up with a number that says 65%, that's an average. That means some were a lot better and some were a lot worse. What is it on your stock? I don't know. Well, then should you be trading that thinking that it's got a 65% accurate or a 75% accuracy based on the fact that that was pulled out of testing 3,000 stocks or something like that? And suddenly the person's scratching their head going, well, I don't know. I guess not. Guys, here's the point. You can find out how accurate a hammer pattern is on your stock at support. Really? Is it a book? Is there an app on my phone? No. You have got to be seeking perpetual beta. If I show you how to do it, well, I'll tell you how to do it. Maybe you can practice it. What you have to do is you find a hammer pattern at support. Why at support? Well, because that's the most likely place that you're going to have a reversal to the upside. And if you throw a hammer type pattern or even something that looks like a hammer pattern and the stock reverses and goes to the upside and has a nice move to the upside, great. That's one. That's an example of what you are hoping to see, something that is actually accurate on this stock. And you got one. So look back, find another support level where it bounced. Was there a hammer pattern? No, there wasn't. Oh, interesting. So it doesn't throw it at every one. Nope. What else can we learn about this stock that we want to trade? Go back to the next support level. Oh, look, there's another hammer pattern. And did it reverse? Yeah, it did. Cool. So now you've got 2 out of 3. Okay. The third one didn't reverse. It didn't go follow through. It just didn't throw a candle pattern, but it did bounce off support. You see, if you're looking at examples where it bounced off support, you're going to see that it bounced off support. What you're looking for, is there any clues? Is there any clues there that would help you decide how much confidence you would place on another move when it reaches support level and then moves up? Now, we could get into charting where we look at support levels where it doesn't work, and et cetera, but let's just stick with candles. So I go back to the next support level. Was there a hammer pattern? Yes, there was. And it reversed? Yes, it did. Okay, now we've got 3 out of 4. That's 75%. And the other one that came to support, it didn't throw a hammer pattern, but it did bounce. I mean, it was a bounce off support. Okay, go back one more. There's the next one. Does it have a hammer pattern? Well, yeah, it's kind of funky looking, but yeah, it's definitely looks kind of like a hammer pattern. Okay, So and you go back, guys, for a year. You find all the support levels for a year. And there might be 4, there might be 8, I don't know. But bounces off of support levels. And if you've got 8 out of 10 that threw a hammer pattern, and a couple, they still bounced, but they didn't throw a hammer pattern, what have you got? Now you've got an indicator. And on that stock, you've got an indicator that you can put a number on it. If there is a hammer pattern at support, 80% of the time it rallies. And other times it rallies, but it didn't throw the hammer pattern. But effectively, when it threw a hammer pattern, it was 100% right. Whoa, do you have something now? Do you have something now? You do. Charles, I love it. Charles throws back one of the phrases that I coined and taught my students in the past, and I've always continued, and I will say it again, and that is learn to listen with your eyes. He said that's been the greatest advice for him. Well, thank you. That makes me feel really good as a coach. Listen with your eyes. The stock will talk to you, guys. It'll talk to you. The charts will talk to you. The indicators will talk to you. But you've got to listen with your eyes. You've got to look carefully, be objective, be open to new beliefs or new information, and be flexible enough to be focused on improvement, not defending your brilliance. Okay? If this indicator works on this stock, great. It does not mean that it'll work on the next stock, and it doesn't mean it will always work on this stock that you are working right now. It might, but when it doesn't, let go of it. Mommy, it hurts. Then quit using it. Okay? Generalizations on candlesticks. Oh, that's a good one. Oh, yeah, that's a. Whenever you throw that, I read that that's a really good trading signal. So, oh, look, it did. I'm going to buy. Bad decision making. Personalize it for the stock, and it's not that hard to do. If you're wondering how a hanging man pattern, when you are at a reversal to the downside, how does that work with your stock? Is it a good signal for candlesticks or not? I don't know. Let's do some investigating. Oh, yeah, but I don't have the book and there's no app and I'm not that smart. Baloney, of course you are. You can see, it will talk to you through your eyes. Find reversal patterns of the downside. Did you have hanging man patterns? Okay, and if you did, and you come out with the signals being 50-50, well then, yeah, I'm not going to place a lot of weight on that. Or what if you go back the last 10 reversals to the downside and there was only 2 times where there was a hanging man pattern? Well, that means in this stock, I'm not going to wait around for a hanging man pattern. There's other things I can trade it. What else did it throw as a candlestick signal? Maybe it was something else. Maybe it was a shooting star. Maybe that's the way the traders trade that stock, and your signal is going to be a shooting star, not a hanging man. Oh, okay. You see? And whether or not you recognize these names that I'm throwing out or not, it doesn't matter. It's a principle. If you were to learn candlesticks, you would read in books, oh, this is a good one. This means this. When this happens, the stock reverses. Baloney. Baloney. Guys, I've studied this for now decades. I've looked at hundreds of thousands, actually millions of lines of data. And all I found out on candlesticks is they can be a good tool if you can personalize it to the stock you're trading. That's it. It's a fascinating subject, but there's nothing magic about it unless you can find that personalization. You can find patterns that actually work on that stock. Guys, the generalizations about, well, when this happens and you have this candlestick formation followed by this one and this one, this is what's happening in the market. Bull crap. There, I said it. Sorry. I say baloney, but for emphasis, bull crap. Nobody knows that unless you can show that to me. Show it to me. Then I'll be impressed. I'll believe it. But I won't be believed. I won't believe you or be impressed just because you can show it to me. I want to see that you did some work on it and you can show me why it works. Prove it. And I don't care how well it does over the overall market. I'm not trading the overall market. Well, I could be. And in that case, I would want to look for that correlation. But on the individual stocks that you trade, you want to personalize whatever you use, candlesticks, moving averages, Bollinger Bands, stochastics, everything. You personalize it to that stock, Fibonacci's, everything either works well for the stock you're trading or it doesn't. And that's all you should care about. Does it work or doesn't it work? If it works, I'll use it. How else are you going to sort through that maze of so many indicators, so much information that gets so confusing? Start with following somebody that seems to know what they're talking about and say, okay, I'm gonna dig into that, see if I can duplicate, see if I can come to the same feeling or the same opinion that you might have on that. And if I can find that I understand that, it makes sense to me, and I can see that it works, great, you've got one. Now keep looking. And your goal is not to get 14. I honestly think that if you're going to use indicators in this way, in this attitude, that 3 to 5 is more than enough. Find the 3 to 5 that you can figure out. It's a lot of work to figure them out, to find out which ones work. But if you can get 3, maybe 4 or 5, but I wouldn't suggest going any more than that. I don't think you need any more than that, because ultimately you're following the price. These are just additional ancillary signals that can strengthen the move. If it actually does make that move with all of these indications, then you will probably have a strong move because you've got history that backs that up. But don't lean into them as if they're magic. Oh, I got that signal, I'm jumping in. Okay. With candlesticks, there's a long discussion I teach on location. We talked about it today, but just in passing. If a candlestick is a reversal to the downside, it's a bearish reversal signal. Where it happens is hugely important. Composition, how it happens. If you throw a hanging man pattern, how did it happen? What do you mean by that? Well, during the day, where did it open? Where did it close? What was the high? What was the low? That's the composition. And if you spread that over the course of the day, when did it open? Well, it opened at 6:30 Eastern, or 6:30 West Coast time, 9:30 Eastern time. Okay. What was the high of the day? Well, it was this price. When did that happen? Like 3 minutes after the open. Really? So 3 minutes after the open, it hit the high of the day. Yep. What was the low of the day? Well, it was clear down here. When did that happen? Oh, about a half an hour before the market closed. Okay, so it hit the high of the day within 3 minutes. When did it get down to the low of the day? It hit the low of the day a half an hour before close. And where did it close? All the way back up close to the opening price. Whoa, wait a minute. So in the last half hour, it went from the low of the day, which was down there quite a ways, and it shot all the way back up and closed almost the same price that it opened. Yep. Well, guys, that's a different story than if it opened, shot down to the bottom, stayed there all day long, and then came back up in the last half hour. That's two different stories. That's a different story if it opened up, shot down, hit the low of the day in the first 20 minutes, shot back up, hit the high of the day, and stayed there all day long, and then basically pulled off just a little bit at the end of the day to close. All four of those are different stories. That composition tells you a lot about what happened today. What was going through the minds of the traders? What were they thinking? Was there any news associated with that? How'd they react to it? That's the composition. That tells you more. So on a time frame, if you're down to, trying to get out or try to get in and you're watching it on a 5-minute chart or something, a 10-minute chart, 15-minute chart, if you're drilling down that granular level, then you're going to want to know the composition. Are you going to have to work harder? You're going to have to work a lot harder. You're going to have to study more. Guys, it's like I said, let me move back up here. Closer time frames increase the risk and the reward, but they also increase the amount of time and effort you got to put into it. Holy cow, you got to watch this like a hawk all the time. Longer term, it's easier to predict, and you don't have to look at it every day, maybe even every week. Maybe you check on it once a month. There's extremes and there's everything in between. So candlesticks is a good example of trying to look at this and say, all right, if I get this figured out, I've customized it, I've personalized it now to the stock I'm trading. And that makes sense. I feel more comfortable about that. Good. Now, if you learn something new, are you willing to incorporate that? Oh, yeah. What if that something new challenges or makes you let go of something that you have been holding on to as something you really thought was an absolute fact? Are you willing to let go of it if new information comes along? Well, yeah, because all I really want to do is get better. Boom, booyah, booyah. So when you dial in and you put the work in and you finally get it working to where you feel comfortable with the way things are going, your decisions seem to be accurate, you're closing out trades where you should, you're controlling your risk, your benefits or your rewards are being capitalized on and maximized. That's great. You're only looking at 3 indicators and it seems to be working. Boom, you're just right for now. You're just right for now. All right. Now, guys, that's my message today. Love the review on the technical analysis. They're a bunch of good tools. I've taught you how and shown you how to figure out if they work for your stock. Don't get too many of them. Don't single it down to a single one. And don't throw caution to the wind and say, I'm just going to wing it. But when you put the work into it and it's working, great for now. And that means I'm open. Show me something better. Show me something that improves what I'm doing, and I'll let go of this and shove that one in. Okay. I'll pull that block out, set it off the side, and put in the new block because I'm worried about or most concerned about self-improvement, not protection of my ego. I'm willing to let go of one belief and accept another one if it's better. That is the key to becoming super forecasters, according to these guys that research that out. And it's probably the simple explanation why in every case, there were outsiders that were better at predicting what the professionals in that particular industry did for a living. Isn't that fascinating? Every single industry they looked at. Everyone. All right. Well, we have some good comments saying that this perpetual beta idea is a great one. Good. I'm glad you enjoyed it. I like what Felicia said. She said, this is such valuable information, more than just reviewing an individual stock. Well, you know, I appreciate that, Felicia. I really do. And I love looking at charts and going through stocks. But you know what? I think that's probably what I'll do. Let's do that on the next time I do Coach's Corner. We'll do that because we've covered enough things to now we can look at a chart and I can remind you and you'll go, oh yeah, that's right. Oh yeah, we talked about that last month or the month before. All of these pieces go into the actual application, okay? But there's a reason why they focus on basics and they do drills on dribbling and drills on layups and drills on defense and drills on all these things in basketball, because when it's time to play a game, you've got to be able to now practice all of those in harmony. You have to do it live, all of them together. And you may not do much dribbling because you don't get the ball, but suddenly you get the ball, you got to be able to dribble. And maybe you've practiced a lot of shooting and in the game you didn't give very many shots, but when the ball came to you, boom, you posted it up and it dropped because you'd practiced it, because you were ready. So let's do that. Next time we will focus on maybe culminating or reviewing some of these things in a class where we can go over the charts. Charles, yes. Answer to your question is yes. Dory, great. Can we look at a few now? No, but I'll give you something to come back for. Okay, good. Barry says, can we use Tesla as an example? He said, in previous lesson from years ago, you said, let Tesla tell us how to predict Tesla. Yeah, I love that. Thanks for bringing that back. That is something that I have said and still believe and would continue to say again. If you want to learn how to play Tesla, we're going to go to Tesla and say, please teach me how to trade you. And Tesla might say, nope, because I don't know how to trade me. There is no rhyme or reason. Or you'll find out this is how you trade Tesla. Okay. Or you might find out there's only 2 or 3 situations where you can trade Tesla. Everything else is going to be randomized muck, and it's not worth getting in there. You'll just get beat up. Okay. But here's a couple situations that work. Okay. Maybe you can learn that you can trade a certain stock around earnings because there's some predictability, but the rest of the year, oh my gosh, or the rest of the quarter, it's not even worth it. But earnings, yeah, you can actually do that. See, guys, that's the whole idea of personalizing it. So thank you, Barry, for bringing that up. Let Tesla teach us how to trade Tesla. I love it. I love it. All right, my friends, we're done. If you have any other questions, there's about 10 minutes, but I'm done. If you're not done, then fire away. Otherwise, we will see you next time. All right. Take care, guys. God bless. Appreciate you so much. And we will see you next time around. Hey, thank you so much. You're welcome. A lot of thank yous coming in. Take care, guys. Bye-bye.